as dire as agencies say in many of their statements.
Right, and to a story that will lead us into the conversation of the day regarding digital lending, the creation of a financial ombudsman to handle the customer complaints pertaining to malpractice by digital lenders is one of the ideas that is fast gaining traction both among members of parliament and the Digital Lenders Association of Kenya. PricewaterhouseCoopers released a comparative study that was in March, of course, on digital lending. And my colleague Alex Mwangi now gives us the highlights of the report, which of course was released 3 months ago.
Digital lenders in the country have grown by leaps and bounds in recent years, but so too has a reputation of nastiness among some of them, prompting calls for stronger regulation.
The issues of data protection, we were having discussions with people who said that, when my brother takes a loan, I receive a message, that he took a loan, and maybe, or the boss receives a message and that kind of thing.
A comparative study by PricewaterhouseCoopers on the regulation of digital lenders proposes the development and enactment of a consumer credit code that embeds the principles of consumer protection in lending. PwC recommends that the code be vested in a regulator such as the CBK or another agency, and that it should provide for registration but not necessarily the licensing of consumer credit providers. The study also proposes having a financial ombudsman to assist in streamlining the issues facing unregulated lending.
Poland, being a member of the GDPR, has strong data protection regulations. So on the dispute resolution, they have a public ombudsman, specifically for customers of financial institutions. And what this has done for them is it's eased the backlog in traditional litigious institutions.
We need to ensure that the consumer understands the consequence of not paying back a loan. The CRB framework is a very vital asset, is a national asset, and we need to stop using it as a tool to punish and more as a tool to enable SMEs.
One of the challenges in the unregulated digital lending space has been the information asymmetry, which is skewed in favor of the lenders.
Transparency in pricing as well, disclosure of key terms and conditions, restriction on certain debt collection practices. We want to have marketing guidelines as well, which would state when you can advertise, to whom you can advertise, because you also don't want a vulnerable segment of the population being exposed to what ordinarily is a beneficial and financially inclusive industry, but they may not be adequately informed.
Currently, there are 2 bills before the National Assembly that could offer the much-awaited legislative guidelines for digital lenders.
We also have the other bill by Honorable Gideon Keter, and the efforts we will be making is to have conversations with Honorable Keter so that we have just one bill that carries everything.
The comparative study by PwC looked at the regulatory models in 11 jurisdictions, namely Australia, Egypt, Uganda, India, Mexico, Nigeria, Poland, South Africa, Spain, the UK, and Singapore. The Digital Lenders Association of Kenya currently lends to 6 million members monthly. Alex Mwangi, NTV.
Right, let's get you started on that conversation. We promised you this morning we are talking about money, but not just money, but money that is borrowed. But not just money that is borrowed, but money that is borrowed on digital platforms is something very common in Kenya. If you check, 1 in probably 5 people has the application or a digital loan application on their phone, and probably they use it once or twice a week. That's what we want to talk about this morning, because there are also some risks to it, including the issues of high interest rates and, of course, the misuse of personal data. My guest this morning to help us delve into this conversation, Reginald Kadzutu, is an economic analyst and a very good old friend of mine. Good morning, Reginald, and welcome to the show.
How are you?
Karibu sana.
Asante sana.
All right. Also joining us this morning is Kevin Mutiso, is the chairman of the Digital Lenders Association of Kenya, popularly known as DLAC. Good morning, Kevin, and welcome to the show.
Asante sana.
All right, and joining us virtually this morning is Rina Hicks. She's an investment banker. Good morning, Rina, and welcome to the show.
Good morning, everyone.
Right. Let's just, of course, But even before we do that, this is something that is at the heart of very many people who are actually watching us this morning. We want you to be part of that conversation. By the way, you can tweet us at NTV Kenyan at Victor Kiprop _. Use the hashtag new normal. This is the question that we have for you today. Have you ever borrowed money from any digital lending app? Have you ever borrowed money from any digital lending app? Please share your experience with us using that hashtag that is new normal. Tweet us at NTV Kenyan at Victor Kiprop _. If you're not on Twitter, you can do this on Facebook. If you're not on Facebook, you're surely on Instagram or YouTube, where of course this conversation is live. And if you're not on social media at all, you have a mobile phone, you can call in and be part of this conversation. But let's just get us started with this. Gentlemen, it's a loan literally within seconds, because it's just a tap of the phone, of the button, and you have money in your phone and you're ready to spend it. Sometimes we get too comfortable and we forget that this may not be the norm in other places across the world.
That's true. I think one of the greatest inventions, I keep saying all the time, is that digital lending is the greatest invention of all time. The reason is that before 2013, it was very difficult to issue loans below 100,000 shillings because of the cost of issuing that loan. Today, you're issuing that loan, you're able to do KYC, you're able to do credit scoring, and you're able to disburse at less than 100 shillings per loan. And so what that did is that now we're able to issue loans of 1,000 shillings, 2,000 shillings, and that was the key innovation there. And so when you say it's not available in other markets, that's true. Kenya is one of those unique markets that is maturing in the digital lending space.
Okay, Reginald, just
yes, I think it's both good and bad.
Yeah.
It's good you can get a loan quickly.
Yeah.
It is also bad that you can get a loan quickly because now there's elements of misuse that can come with that. And then there's a social cost that comes with the ease of getting something. It's just like in medicine.
Yeah.
There are certain meds you can just go over the counter and get. There are certain meds that you go over the counter and you'll be told, no, my friend, here you need a prescription. Why you need that medicine. So it is a good platform. Innovation is always good. Innovation comes to solve a problem. You'll always have disparities between jurisdictions because of, for example, if you look at the data that shows which application people use the most, when you go to Europe, Western countries, it is not a mobile phone. It is split 50-50 between mobile phone and their computers. Go to Asia, India, it's largely the mobile phone. So I always tell people, do not compare Kenya with the Western world in terms of we are developing digital lending. They don't need it. So you don't, as in you get an innovation for something that there's a solution that you're trying to solve.
Yeah.
And for African countries where we've had low penetration rates of financial solutions and services, most people are using their phones. Everyone is a phone everywhere. So because of that growing penetration of simple phones and even smartphones now, it helps things like digital lending to grow. But I guess the element of regulation now needs to come in because too much of anything is not good.
Yeah, and of course we'll come back to these issues of the downside and all that. But let me just bring in Rina very quickly. Rina, definitely we will highlight, of course, the downside of having all these issues and too much loans, as Reginald would call it. But clearly for a market like ours, where, of course, access to finance is still a problem, this is really something that is welcome.
I mean, definitely. It's a great improvement in financial inclusion. In terms of, there's business people who are small traders, they need money quickly, they can't go to the bank because they don't have collateral, and they can easily, borrow. I think the innovation, as Reginald says, is really something that has come to solve huge problems. But as time has gone on and as the lending practices have evolved to cater for risk for the companies that are in business and to cater for, just the ability to collect what they've lent, unfortunately, the question now begs, is it really financial inclusion? Are we still including these people? Or are we excluding them eventually?
Yeah.
And so I think it's brilliant. I think Kenyans from a digital perspective are extremely innovative, and it is to be encouraged both by customers and also regulators. But there has to be some way of trying to limit it so that then when something now begins to be an issue, preventing customers from being able to access these opportunities at the end of the day, then something needs to be done about it.
Okay, and of course we will, of course, touch on all these issues in this conversation, but maybe we can start there. This growth is amazing. It's almost crazy. This is something that I believe began probably around 2015, 2016 there, but all of a sudden it's everywhere. There are quite a number of lending apps out there, and there are quite a number, of course, of Kenyans who borrow every day. The figure is in billions. Reina?
Oh, I'm sorry. So what's the question?
Yeah, I'm saying we can actually begin from right on the very same issue of growth, because this began probably 4, 5, 6 years ago. And all of a sudden, we are in this situation where there are a lot of providers, probably in their hundreds in Kenya. And of course, people borrowing literally every minute.
That's true. That points to a bigger issue. I think borrowing money is okay. However, when you start to borrow and depend completely on it, then it becomes a problem. In fact, I think there's a social issue here, because what has happened is you find that due to the ease of access, what's happening is that people are not planning their finances well. They're borrowing and to meet a need, and then find that they don't have enough cash to pay back and borrow from another lending app to pay the other lending app. And so it becomes, you find a lot of these borrowers end up in a huge cycle of debt, resulting in a lot of stress, a lot of challenges. People are in distress and unable to move from where they are to where they need to go from a financial perspective, unable to meet their basic needs and living in debt. Forget saving for a rainy day. I mean, people are in serious debt. And I believe that's why we've had all these complaints. It's not just about data and privacy issues. It's also not just about the price of the loans. It's also about literacy issues and people beginning to understand why I should borrow in a certain way, or why I should not borrow, why I should save for a rainy day instead of relying on mobile apps and easy access to money. And so that's why I feel that while I recognize that businesses come to solve an issue, but the moment that that solution then begins to affect livelihoods, then there's a responsibility by those businesses to educate their customers so that they use the product or service for what it was intended and in a responsible manner.
Okay.
So I think literacy issues is something else that needs to come into play.
Okay. But before we even get into these issues, Kevin, the magic here is the convenience.
The magic is the convenience, but I also want to just touch on the history of digital lending so that we can contextualize the conversation.
Okay.
So in 2007, M-Pesa is launched.
Yeah.
By 2013, we have CRB regulations that are released. Having been a lender for over 17 years, I remember the excitement we had when the CRB was now being operationalized. By 2014, we had our first digital lender. Actually, by 2013, M-Shwari had already been launched, a bank digital loan. And then by 2014, you had smartphone apps being launched. The first one, Mkopo Rahisi, now another business.
Yeah.
And then fast forward to 2017, you had about 100 to 300,000 people on the, 3 million people on the Credit Reference Bureau. The Credit Reference Bureau is not a blacklist. It's where you put people's data, whether they borrow, when they borrow and when they pay back, whether they pay back or default, we record that in the CRB.
Okay.
And then by 2021, today, we have over 12 million unique records in that CRB. Right? And then by 2019, you had over 100 lending apps. Then, of course, COVID came, and now we are down to about 50 lending apps.
Okay.
Now, for context, the market has grown rapidly because the regulatory space allowed us to innovate, allowed us to play around with different products. As Rina has rightfully said, we've now gotten to a point of maturity where we now need to start having serious conversations because the consequences of our products are now affecting society.
Yeah.
I love that Rina has brought up over-indebtedness. Over-indebtedness is something we realized that is creating social disharmony, where you're finding...
Let me just stop you there because I'm intending to come back to that issue just briefly. But back to that issue of conversation. When we talk about these issues and the negative side, we actually overlook the positive side of this because I mean
and that's what I wanted
it's
to
3
bring
a.m.
up. Yeah.
I need 10,000 really quickly. It's a medical emergency, and that app is probably the only thing that can save me.
Yes. In fact, 84% of our customers are informal sector entrepreneurs, right? People who understand what the capital is for. The other big innovation that we have is that what you said, anytime, anywhere. You don't have to come into a branch. You don't have to do KYC. You know, in the old days, you had to come fill in a form and say, my name is Victor, write your phone number. Now we pick all that data and we're able to score it, confirm it, and know that it's actually Victor. And so there are many innovations. In fact, one of the big things that I keep saying is that we are not yet there. We have not issued a digital loan above 100,000 shillings. In the US,
Really?
yes, in the US,
Then how do the figures range?
the average loan size today on a digital lending app is about 4,500 shillings. In the US, over 70% of mortgages are digital loans. From start to finish, the customer doesn't have to go on site to seek the loan. They can do it all on a digital platform. And that's the innovation. So what the industry now wants to get to is get to that point where we can offer more and more relevant and different diversified digital lending products.
Okay. And Reginald, definitely this has also been embraced by the mainstream banks. Come on, we've seen quite a number of products which should ideally qualify as digital from the mainstream banking system.
I think the growth has been phenomenal,
Yeah.
Which is true. And it is also true that it is because the regulators have given them space to do that. And we are getting to the point of getting formal regulation because of a failure of self-regulation. I'll give you an example. Do you know people borrow more from shopkeepers and chamas than from digital lenders, even in amounts? Have you heard anyone saying that we need to regulate shopkeepers from lending?
Okay.
And the highest defaults are actually on shopkeepers, even more than digital lenders. Defaults are also high in chamas. But have you ever heard someone coming to say that we need to regulate chamas? If you want to form a chama, you need to get a license, you need to whatever. It's because there's an element of self-regulation that has managed to work for that industry, for that sector. So I think the rapid growth was good, but then there came the failure of self-regulation, where now you have rogue players, you have good players, you have whatever. So now you need to get a regulator that has to come into place.
Okay.
But if the digital lenders themselves are able to organize and effectively self-regulate, you realize central bank will not have had to come in. M-Pesa has run without regulation for quite a long time. It was neither a communications authority product, it was neither a central bank product, but they managed to kind of regulate themselves for quite a while.
So there is a dark side to this growth.
Yes. So if you look at it, I think all the ills that we are seeing now are also as an event of a failure on self-regulation on the digital lenders, which somehow shopkeepers and chamas have been able to figure out. And you know, if you default at a shopkeeper, you still need to go buy sugar from that same guy tomorrow. So you realize there's that inherent of no, everyone in the village will know that I have not paid or I can't get my my sugar from there. So there's that element that needs to be looked at also in this discussion.
I think Kevin is itching to respond to the issue of self-regulation because he's been on the front line for this.
Yes. One, we want regulation. The reason we want regulation is because we have now become big and we now need a certain level of predictability in the market. The shopkeepers and the chamas are not deploying the amounts of capital we're deploying into the market, right? We have lenders in DLAC who are deploying up to 1.52 billion shillings a month as individual lenders.
2.5 billion.
Yes, in a month.
Do we have
There's no shopkeeper doing 2.5 billion. Therefore, if they suffer defaults, you know, it's manageable. When we suffer defaults on deploying 2.5 billion in a month, it's serious. And so we've gotten to that point where we also want regulation so that we have a minimum rule book. So that the rogue players stop the bad manners, stop contravening data protection laws, and then we can also reduce the cost of borrowing, because we also we also borrow our money. And because there's so much risk in the market right now, if we get regulation, our cost of funds will come down. And even for the customer, the pricing will improve.
Okay, and because you've raised the issue of the cost of lending, and I think, Rina, this is where actually this issue of regulation perhaps should come in.
Absolutely. I mean, and one of the things that is an issue is the issue of transparency. And so, it's that 3 a.m., your child needs to get attention in the hospital, and you borrow quickly from the easiest means. You may have a sister who's happy to help, but because this is more convenient, you go ahead with it, not knowing that if you don't pay within a month and you wait, for a year, for example, digital lending apps, you can't wait that long. But the point is that you end up paying huge amounts of interest, upwards of 135% per annum, because it's 2%, 5%, 7%, even 10% per month for some of these loans. And so it's important for people to understand that. So that lack of transparency is a huge issue, because without transparency around fees, around the cost of the loan, then somebody is not able to make an informed decision. I think that's where the issue of the regulation is coming in. It's not so much to prevent digital lending companies from doing business, but it's creating a fair playing field so that as I make a decision as a customer, I'm making an informed decision. So I understand that pricing is sort of trying to price risk in, and that's important. And that's where we're able to give and lend money rather to people of all different kinds of backgrounds, but they need to be aware what they are paying for that money.
And that's very important, because I was about to come back to you on that point, because if you go to the bank today, they'll ask you for your payslip, they'll ask you for the logbook, they'll ask you for a title deed, but these guys don't ask you that. They just need your ID number and your mobile number. So I would argue that I really, we're just pricing risk. The risk is higher.
Absolutely, it's higher. In fact, one of the things that I find fascinating is how these digital lending companies have developed credit scoring models that use, M-Pesa, they use our social media behavior to then credit score me. I think it's brilliant. However, I need to know what my score is. I need to know what my pricing is as a customer, so that then I know, as I'm getting into this contract through my phone, what I'm paying and the cost it is to me.
Okay. All right. Maybe even before you respond to that, Reginald and I need a very quick loan of 10,000 shillings. So Reginald gets it at an interest of, let's say, 10,000. So you repay 10,000 plus maybe an interest of 3,000 bob. I, on the other hand, am charged, let's say, 5,000. How do we determine who gets charged a higher interest?
So first of all, those rates are quite high. 30% and 50% is not in this marketplace. But typically what we do is we take, as Rina said, a lot of data off the smartphone. We also take a lot of data off your M-Pesa, and then we run it through our credit model. So what tends to happen is we've built AI scoring models, and the objective is a risk-based pricing. Now, the reason we want risk-based pricing is because that's the most efficient way of measuring the risk and measuring and trying to predict the return on that customer. And so that's how we do it. So the reason Reginald would get that rate is probably because he has taken loans before and repaid more loans on time. We call that willingness to repay. And if you're able to demonstrate that willingness to continuously repay your loans on time, borrow when you need, not when you want, right? Because we can see that data, we sort of call you a lower risk. Those of you like Victor, maybe he's always in the club on Friday trying to take extra cash so that he can, maybe buy an extra round or whatever. We track that data and we can see this is a higher risk customer and therefore price appropriately.
Okay. Yeah. And there in that tracking, Reginald would agree with me, comes an issue of data privacy.
Yes, but then what we have to do by law is seek consent from the customer. What I agree with Rina is that we need to be a little bit more transparent. And in fact, I liked that you brought the PwC report, because one of the key things we said is we want to have marketing guidelines. We want to remove what we call the legalese from the terms and conditions. And the terms and conditions need to be very clear. And then the consent, how we seek consent. We explained to Victor that if you click yes, we are taking your M-Pesa data, we are taking your smartphone data, and we are going to track you for as long as you have the loan. If you say yes, that by law is allowed, as by the Data Protection Act 2019.
Reginald, do you want to respond?
Let me give you some examples of the data privacy clauses.
Yeah.
Kenya. Under the General Data Protection Regulation or other applicable local laws, you have the right to access, rectify, port, erase your information, as well as the right to restrict, object to certain processing of your information. This includes the right to object to our processing of your information for direct marketing, the right to object, it goes on. Gets the idea. For this purpose, I hereby waive my rights to the confidentiality of client information and expressly consent to the processing of any personal information and records relating to me that might be obtained from third parties, including government agencies. TALA. I authorize TALA to verify and investigate the above statements information as may be required from the references provided and other reasonable sources. For this purpose, I hereby waive my rights of the confidentiality. PESA zone. We will seek to protect your data and funds available in your account. However, this is something that we are not able to guarantee. You consent to the storage transmission of the data. Branch. Should we wish to use your information for marketing purposes, we will inform you prior to such. You shall be entitled to prevent such usage going forward. Then it carries on like that.
Okay.
Someone who most probably has not finished class 8.
Yeah.
How are they to understand that statement?
Because because what we have to agree is this loans sometimes go to the unbanked.
Exactly. I'm saying, how are they supposed to understand all that legal language? Someone has just clicked yes to, I waive my rights to private confidentiality.
They don't even know what private
if you look at what banks, in terms of the data that banks ask from clients, normally it's your name, your ID, PIN, and some information. If you look at the data digital lending apps are collecting from individuals is way more than that. And not because it's an app. You know, a bank, it's a paper. An app then asks you access to your contacts, access to your gallery, access to your whatever. All those are data. That's all my paper. What does that have to do with me getting a loan? So there's a huge need for data protection that needs serious regulation. Where I hope when CBK come up with the regulation, they will actually specify and say your app should not be able to access 1, 2, 3, 4, 5.
Kevin, I can see Kevin is really itching to respond.
Yes, because one, that is why the banks are unable to solve the problem we're solving of financial inclusion. They're still using paper, right? So shooting us and saying that we are bad because we're taking all this data in very innovative ways, I think is the wrong approach. I think what matters is are we teaching the consumer what the consequence of entering a contract with a digital lender is.
Okay.
And in fact, in South Africa, they have a regulation where if they find out that the customer took the loan and was not explained to the terms of the loan in the language they understand, that contract can be nullified.
Okay.
Right? So what we are saying is regulate us, right? Let us ensure that we are communicating effectively and transparently to the consumer.
Okay.
But don't tell us, do not take the data, because then what you're saying is don't lend to that customer.
Rina, Kevin is using the word, and I've taken note of this, the word innovative. Is it really innovative or invasive?
A little bit of both, but it's definitely innovative. Because you see, if they were not able to get this data, then how would we lend? How would these digital companies be able to lend? The ability to make a decision on whether or not to lend to a customer is based on whether or not you think they will repay. And so they will go into my M-Pesa. If they find that every Friday I am betting on some kind of app, and and I want to borrow on Thursday or Friday, it's going to be clear that I'm borrowing to then go ahead and bet. And so I'm a higher risk customer. Without that information, then they're not able to be in business. I think the issue is not so much the access, in my view. It's not so much the access of that data, because it's important to do the credit scoring. The issue is, how do they use that data, and how private is that data? Now, when a digital lending company starts calling my sister or my cousin or my best friend, because they saw that we are in communication all the time, then now we are crossing lines. And I think that's where the issue is.
Okay.
And a lot of complaints have come from the fact that people are feeling embarrassed. My brother has been followed and is being told that I borrowed money of a certain amount. That's what is not right.
Yeah. And that is, of course, the most critical part of this conversation, because Reginald would agree with me that we've even seen cases of people actually, what you would say, dying of suicide because of the shame that comes with people accessing data, calling Reginald's sister and telling her, you know what, Reginald has not paid this loan. Your sister didn't know you had taken a loan. So this is personal information that you're sharing with the public. But I think this is something that we will see very commonly in the feedback that we want to take. Remember, we asked you in our question, have you ever borrowed money from digital lending apps? Have you ever borrowed money from digital lending apps? Let's get to see what some of you have been saying. Thomas Mabele Simi says, a friend borrowed. He told me those guys can call even your ancestors to tell them you borrowed money you don't want to pay. I think that's literally what we've just come from talking about. Wafula says, I have Ontimiza and I'm sorry, but I work hard to repay. That denied me because of my poor performance in paying back. It would take 2 months. Thank you, Wafula. I think 2 issues I've noted there. And then, yes, Frederick Rari says, those apps are like drugs. Once you're hooked, you will never taste freedom of your mind. Quite a number of issues coming forward right there. And David K says, it's called monkey traps. You know that you know, but you are trapped. You end up paying interest of 90% per annum, but you can't let go. Thank you, David. We can get someone. Adopa says, avoid like a plague. Those guys can harass and embarrass you with buyer. Thank you, Adopa. Do we still have more? Yes. Ricky James says, I have and never paid back. Their interests are so high. Okay, quite a number of issues coming up. Pastor Ali Malim says, okay, Pastor Ali Malim. Okay, fine. I like the name. The worst platforms for credit, don't dare them unless you sleep. Your sleep isn't a precious thing to you anymore. The moment you are indebted to them, that is the end of your peace. Thank you, Pastor Malim. And then, of course, lastly, we have Leopold Shui Ngare says, even before a week elapsed, they started calling my mom, boss, my ex, and any contact they could come across my phone book. Thank you, Leopold. And I think, gentlemen and lady, quite a number of issues have come there. Of course, Kenyans expressing their concerns, and I think I took them. One of them is, let me start with you, Reginald. So you've broken up with an ex, and you're not dating this person anymore. But because Kevin and other lenders have your data, they call her and tell her, you know what, Reginald has a debt of 50-something thousand there. Just tell them to pay.
That's the sad part of it, and the data protection element we are asking for regulation on. So we are not refusing them to get access to data, but get access to relevant data that you need for credit scoring. My contacts in my gallery, I have nothing to do with credit scoring. Yes, my M-Pesa transactions, you want to see my ability to pay. It's the only other digital form that you have. I may not even be using M-Pesa, but I actually have a ability to pay the loan. So when regulation comes, because what is being debated in Parliament is an amendment to Central Bank Act to give them the powers to regulate and come up with the rules. So I think Kevin and team should not be celebrating before they see what Central Bank are actually going to come up with. And you know what Central Bank comes up with is not debatable because it does not go to Parliament. It becomes a rule under the Central Bank Act. So what we would want to see Central Bank say is, as a mobile lending or digital lending app, this is the data you should have access to. This data you should not have access to. So regulation will be good, but it's going to remove a lot of rogue players from the market. That one I have to put in place. It's going to remove a lot of rogue players. But just on that element, so that we also don't lose the context. Easy credit is not a solution to a problem in Kenya. Are
you saying this thing may not be solve our financial inclusion issues?
No. We have, number one, a real big problem. It's not that banks are not innovative, as Kevin said. But banks have an alternative. Government is borrowing at 14%.
Yeah.
Why should I stress? Yeah. So that is number one problem that needs to be sorted out. Number two, if you look at the data that is there, and Kevin can tell you, the number of people that are actually borrowing for hospital are very few. Majority is consumption. Yeah. People who don't have enough income are complementing their income with credit, and that person automatically becomes into a vicious cycle of borrowing. So again, the problem there is not access to credit, is how can he grow his income and live within his means without getting credit. If we start solving those problems, Kevin and Tim can actually become digital lenders to the mama mbogas who are looking for working capital to be able to refinish their business, but stop funding Victor, who wants to go to SportsPesa or go for to go to Naivasha, you know, or go for a holiday that he knew that he wants to go 12 months from that holiday and he just didn't plan.
Okay.
So there are bigger problems which we should not lose. That digital lenders are coming to fill in this gap, but it's a symptom of a bigger problem that the government actually needs to sort out. So regulation will just remove the rogue players, but we will not remove the problem of which Rina brought up. That, and if you've heard from everyone there, once you start getting these loans, it's like a drug. Why? Because you've taken it to complement income. If you've taken it to complement income for consumption, when you get your next income, what are you going to do? You're going to repay Kevin,
and then
after you repay Kevin, you have to borrow again, because now that portion that you could have used, you've used it to repay Kevin. So that should not be lost.
Kevin, I want you to respond, because really it should concern you, even as the lender at this point, when someone has died of suicide because a lender used unethical practices to shame them.
In fact, we were very empathetic when that story came out about a year ago. And we took a very hard stance then, and we actually came out in public and called out those rogue lenders.
Are these people your members?
No, they're not. So we called out those rogue lenders. We actually put out in public that those are not our members, and we told customers where they should go to seek the same service from lenders who do not do the legal calling. And then that's the other thing I want to make very clear. Calling your customer, your phone book, is illegal. It is illegal under the Data Protection Act 2019, because the person you are calling of the phone book has not consented to be a guarantor of that loan or to be a reference to that loan. Therefore, because they have not consented, they are not allowed to call. And then I'd like to add that DLAC, what we've been doing, we've actually reached out to some of the rogue lenders, and there are some that in the next 6 months have agreed to stop the practice, and there are some that have said they do not want to stop the practice until the regulation comes.
And I think, Reginald, if anything, then that justifies the need for regulation, because these guys are going there in some sort of persuasion, because these are not your members. You have no authority over them. Just asking them, please don't do this, don't do that. So if anything, for me, it justifies why we need a regulation.
And I only think one of the regulations that CBK needs to come, so that we don't kill self-regulation in the market. One of the regulations is for you to be licensed by CBK to be a digital lender, you need to be a member of a professional association.
Exactly.
Because these are the ones that can keep ethics. These are the ones that can highlight and
like KBA
report.
for the mainstream bank.
Yeah, just like KBA, like ISPAC, this character called Isifa, and all those other guys. So if CBK does not put that in their regulation, they've effectively killed self-regulation.
Okay.
In fact, I think I love that Reginald has brought that up. This CBK amendment bill is actually a very unique opportunity for Kenya, because if you think about it, it's a fintech bill. And if you look at any market in the world, Egypt got a fintech regulation the other day. The amount of investment that comes right after a bill like that is passed, because fintech is the industry of the future. You know, we keep focusing on digital lending. If you really think about what digital lending solves, it has been able to solve KYC scoring and disbursement. But that means we can do savings, we can do insurance, we can do all these manner of digital financial services. And distribute them quickly to the market. And this CBK Amendment Act speaks to that. This is a huge moment for Kenya, but because we are focusing on the negative elements but our market, the industry has sort of brought up, the debt shaming, for example. We might lose this opportunity and focus on trying to clip the wings of innovation rather than making sure we can fly and innovate and actually receive a lot of capital. I'm sure you've seen what the Nigerians are getting, $200 million, $150 million. Why are Kenyan companies not getting that?
Okay.
It's because we do not have a fintech law.
Okay.
So this CBK amendment bill is that opportunity, and that's why we keep saying we want regulation. And one of the points we put in our submissions to the committee is, yes, self-regulation should be part of the solution. Use us as industry to whip people into shape.
Yeah, and of course we'll be going into the details of those regulations which are in the bill, which are still in Parliament for now. But Rina, before we go for a break, clearly another issue that came out very strongly is the issue of the addiction, because from what the feedback we read out was, you get hooked. It's like a drug, and that's why maybe you see people who they have already defaulted on one app and they go up taking other loans on 3 other different platforms.
It's very sad. Actually, one of the effects of easy credit, and it's not just in Kenya, as Kevin says, is the fact that it fuels consumerism. You know, you're sitting in your office, somebody comes in with nice looking shoes, you don't have the money, you fuliza or take a loan from Tala or Branch or any other app because of ease of being able to access this money. So that's the issue. I think one of the things that needs to be done is for people to be educated about the dangers of borrowing to finance your day-to-day needs. Some research that was done in 2017, and I know the numbers must have changed since then because time has gone, showed that while 35% of those who are borrowing from these digital lending apps were borrowing for business-related activities, 27% of them are borrowing to finance day-to-day living, consumer issues, which is where now there's a big problem.
Okay.
So, the reality is, in fact, RBA themselves, I remember the former CEO stated that 80% of Kenyans, 8 out of 10 are retiring poor, unable to meet their day-to-day needs. Now, if that's the statistic, I think we have a crisis. And so ability to borrow is great. Financial inclusion is growing. However, we have to keep in mind that we want to ensure that our people are able to survive and thrive through their life,
but Rina,
not struggle because of access of some of these things.
The young people would tell you that you only live once.
But we need to live well. Even if we live once, we need to live well, not just for our immediate needs, but also for when I'm 60 and I might live to 99. So what am I going to do for the 40 years that I'm alive after I retire? I mean, there's some things we really need to pay attention to and be alive to. It's not just about our immediate needs, but also planning for our future. And it's also being responsible as I borrow and plan, not just doing it because it's convenient and it's easy. Yes, I only live once, but I need to plan so that I can live well, even as I live this once.
All right. So clearly the access that the easy access that we should be celebrating is becoming some sort of a double-edged sword, as Reginald had mentioned earlier. And this, of course, conversation continues to, of course, become exciting and interesting to even, of course, the people engaging us on social media. Keep sending those tweets at NTV Kenya and at Victor Kiprop _. We have to go for a quick commercial break, but when we come back, Kevin will tell us then, if you can't borrow for daily needs, what time should I borrow? What is the best thing? What is the best urge for me to borrow? And of course, for the person who said that they threw away the SIM card and they're not going to repay, what happens to them? We do that after this quick commercial break.
Just one capful of Dettol is enough to disinfect surfaces and protect your family and your home. Dettol, tested effective against COVID-19.
Invest in the prime plots from Finca Properties Limited, Equator Gardens Nanyuki, a gated community ready for immediate development. We also have Konza Suburbs, a gated community within Konza Metropolis. For details, call us today. Finca Properties Limited, prime and affordable.
Thank you for staying with Your World on NTV. This morning we are talking about digital lending. It's amazing. It's growing at a very explosive rate, but there's a downside to it because the interest rates you're being charged might be too high. There's an issue of how your data is being, of course, used by the people who lend to you. And there's an issue of what you'd call a debt trap or addiction. So what happens? What time should you borrow? What should be the ideal interest rates? We answer all these questions, and we want you to keep asking us more because, of course, my guest this morning, Kevin Mutiso, is the chairman of the Digital Lenders Association of Kenya, DLAC. Of course, this morning as well is economic analyst, that is, of course, Reginald Kadzutu with us, as well as an investment banker, that is Rina Hicks, helping us delve into this conversation. They'll answer literally every other question that you have. Speaking of which, we have some on social media. Let's get to see what you've been telling us. Kings Alex says, I once took a loan and defaulted for 3 days. Walipigia mom nikiwa na yeye, asking her to force me to pay back their money or they come for us. Thank you, Kings Alex. I think that's an issue we've tried to address before. We have Charles Minor says, you keep on borrowing and they don't increase the loan limit. If you count the interest rate you paid for this loan, you realize that you're borrowing your own money. They are lucky for dealing with the desperate Kenyans financially. Thank you, Charles Minor. Edu D. Murash says, one advantage is that they are readily available and accessible, but the greater disadvantage is that this kinds of loan, you don't grow because once you get yourself in these traps, it's like an addiction. You will be getting your salary and paying the loans and retaking them to sustain yourself. If you can avoid it, run very fast away from them. Thank you, Eddie D. Murash. Very comprehensive feedback there. Patrick Momo says, those guys are dangerous. Can't imagine the shame I underwent with their rude customer care trying to threaten my my Mzungu Bay. Thank you, Patrick. Kenneth Keitany says, they are so addictive. Same way Kenya is borrowing loans from China. Even after telling them I will pay in the evening nikitoka job, they are never patient. Thank you, Kenneth Keitany. And Isaac Mwenda says, people are complaining without telling us that this is the most efficient way to borrow. You don't have to call your friends, family asking for money. You just touch a button and pop, you have money. Thank you. I think really the feedback are quite comprehensive and the people are a bit more informed. But just to revisit something we mentioned earlier, there's a viewer who said that they took the loan and they said they're not going to pay back. And this was a very common issue back then where you just borrow and you throw away the SIM card because you don't want to pay.
So that adds to the cost of the loans for everyone else, right? Because we have to calculate that there'll be a percentage of people who will not pay back. And in fact, there's a real consequence to that. And, you know, one of the key things we've identified in digital lending over the last few years is lending to under 25-year-olds has a very high default rate. And when we investigated the reason the default rates under 25s, we realized it's because they didn't understand two things. They didn't understand the consequence of default, right? Because the consequence of default in this market is being listed on the Credit Reference Bureau as a defaulter. Now, the way the Credit Reference Bureau works in every market in the world, it becomes the sort of the minimum level of trust in a society. Therefore, at some point, as the CRB becomes more, gets more data and critical mass, to even move into a house, you will be going to get that house with your CRB report and whatever other documentation. To get a job, it will get to the point where you need to come with your credit report and other documentation.
And this is really affecting young people.
Yes, and why the governor of the central bank did a very wise thing last year, where he insisted that a certain amount of records be deleted and given a second chance, right? So what I tell that customer is, you now have a second chance. Pay your old loan, access a new loan if you are using that loan for economic activity, and repay that loan on time.
Okay.
Because the consequence of not paying that loan is going to affect you further down the line.
Okay. And these consequences, you would agree with me, is a bit too heavy for 2,000 shillings, Reginald. To be listed on the CRB, it blocks you from accessing a job, and you just took a 2,000 shillings loan that you probably didn't need. You just needed to spoil someone's, well, I'll not say it on there.
Muzungu Bay. Yeah, but there's a bigger social problem that is there in the country. As these regulations do come, I would actually rather say, as a beginning, yes, we've given a free rein and everything. I might sound radical, but I think central bank should not come and say, before you lend to someone, they should have had at least this volume of M-Pesa transactions, for them to be able to get a digital loan. Because the issue of access to credit in the economy is good for private sector who are doing economic activities. Yes, consumption is good here and there, and all, but ability to repay becomes a big challenge. You know, credit scoring is good, yes. Kenya is a credit rating, but we know the problems that come with it. You only pay for a loan from revenue or from income. The digital lending parameters and I will not show you whether you have a job. You know, I can have M-Pesa transactions because maybe I'm processing M-Pesa for other people. That increases my ability. But even if you do have a job, even this goes to banks, you find a waiter who has a loan for 80,000 shillings. But this guy gets paid 20,000 a month. What are they doing with a loan for 80,000 shillings? So I think as an industry, they might need to take a step back and say, guys, yes, as much as we are profiteering, we are making, Kevin are making money. Let's be honest. For those who actually do pay. Yes, their source of funding is expensive.
Face doesn't agree that he's making that much money.
I was about to say something, but
I'll comment when it's my turn.
But you'll find, yes, their source of funding is high. Because if you look at where they get their money, they're getting their money at 18-20%. That's why they can never lend for lesser. And I pray central bank does not come and try to cuticle the interest rate that you can lend it, because that's one thing the governor is very keen on, making sure interest rates are low. Because if then you do that, you cut their source of funding and you kill the market. But let's look at it. Who actually needs credit? Can we get credit to the mamambogas, to the guys making furniture, to the guys making metalwork things and stuff like that? So that is productive credit for the general good of the economy. But if you concentrate on giving credit to 21-year-olds just because they have an ID, 23, 24-year-olds, we are creating a disaster socially, which this innovation which we are celebrating, Rina gave a statistic. Even the people that are in formal employment, the retirement adequacy is around 70-75% rate. But the amount of people that are there in this country are very few. So we have a big social problem that is going to come and will bite the government further. I would rather say, government of Kenya, yes, we'll allow digital lenders, but be stricter on the criteria of the people that will get these digital loans. Because if they actually go to the people in the informal sector who are actually doing economic activity, Kevin and team will be happy. Because they're lending out, they're getting repaid, they're lending out, they're getting repaid, and all this story of, nilipigiwa, this whatever, will also end, and their businesses will thrive, the economy will thrive.
Kevin, briefly, because Yeah.
So no, we're not making money yet. And the reason we're not making money yet is because we're still a young industry. It's true. If you look at any industry in the world, right, it takes about 10 years before you start making any real return on any capital investment. And in Kenya, the challenges we've had with issues around non-repayment, customers are not repaying us on time. I'm telling you, it's a real issue, right? The cost of capital, he's saying 18. The last time we were together on TV, it was actually 18. Today, it's 28 because of the dollar hedge. The dollar hedge is 15% alone, right? So the cost of capital is going up.
Yeah.
The customer is not repaying. We are also, there's also other issues such as COVID, economic downturn, etc. So we're not making money yet, but we've not given up. We genuinely think there's a lot of opportunity.
And that issue of not making money, Kevin, and I'd like to interrupt you on this one, because that raises another question that the central bank should address. Then how do you, break even?
And that's what I was going to get to. So one of the things that happens as an industry is maturing is we become better and better and better. And so, to Reginald's point, today I can tell you by looking at data sets, this is a boda rider, this is a hair salonist, this is a mama mboga. Why? Because we've now have 3-4 years of data. We've been looking at trends. We can start seeing. And what we've all decided, and our objective initially was to lend to the informal sector entrepreneur.
Yeah.
Right? That was always our objective. Now we have figured out how they look like from a data set. We know how the bettors look like. We know how the salaried employees look like. We know how the partiers look like. And so what you're now going to start seeing, once the regulation comes, the market will be de-risked, the cost of capital will come down, there will be a minimum rule book, and now we'll start making money.
Okay. And I think because we mentioned the issue of
No, I'm just worried. If you're not making money on a loan that you're charging an annual percentage rate of 480%.
But then 40% of your customers are not paying back.
Yeah, but that's still 400. As in your pricing, you've already factored in that fact. So
but
it's
the
biggest.
The principle is an issue, and that's the challenge.
Customers there will
don't
be some
understand
scrutiny that will
repay.
come with this bill, and I'm sure it will try and show us where Kevin is getting his money, what are his sources of money, because that's also quite another issue. But we've really mentioned the issue of young people borrowing money to go to quote-unquote Naivasha to go for a party on Friday. And I think maybe we can get to this story of my colleague, Brian Mushiri, who spoke to a young man and actually asked him these issues. Did he borrow for a party, or did he actually have a very genuine reason?
I got introduced to digital lenders by a few friends. Then you referring someone else to digital lending, it meant you were to get a bonus. Yeah. So if I called you and you registered and you took the first loan and you paid, I would get about 200 bob, 500 bob, depending on the platform that you borrowed from. So that's when I started, because someone who introduced me to it. And then you see, I also wanted to introduce more friends so that I get more bonuses. Gradually, I began now borrowing from different platforms. And, again, the economy also, I felt this was the right time, because they came at a time when you need cash, you need fast cash. You'll get fast cash. And I began borrowing now largely, like from every platform that there is. Each platform has its own way it works. So there are those that will give you a good first loan. There are those that will give you a very low first loan. And then there are those that even on the first loan, you'll pay a very low interest rate, or maybe I not pay interest at all. Now the problem came when the more cash they give you, the more interest they will demand. And eventually now I started getting into debt, because you're given a loan of 1,000 bob and you're told to pay 1,700. You see? That interest is a bit high. We all want to be financially disciplined. That's why sometimes you work with the amount of cash you'll spend that day. But with such lending apps, you find yourself stuck in between, or you've admired something and you say, it's only this one chance. The best thing to do then is you borrow. Instead of borrowing from someone, people can be on your neck a lot. You'd rather borrow from these digital lenders. I must give these digital lenders credit. They do good advertising and marketing, and bonuses, and they cut interests. So in a way, there were lots of marketing. So in that, when it's advertised too much, you're tempted to get into it. And once you get into it, sometimes unhooking yourself may be the challenge now. So I think it's mostly through advertising, and then also through the internet. You're scrolling through, then there's a pop-up. What happens? You'll get curious. Okay, can this give me a better loan than the other one? Can this one give me better interest rates than the other one? So eventually you find yourself in all platforms, every lender you either owe every lender, you're trying to borrow from every lender. Defaulting is the major challenge you get into, because most loans have a period of either 14 days or 30 days. So you might find yourself in a tight corner. After the 14 days have lapsed, you've not paid the loan. And now the only option you have is to now either start, block their numbers, SMSs will begin coming in, and they're very nagging, by the way, sometimes. Although we owe them the money, but there's some level of discomfort you experience because of the calls, because of the constant SMSs, a number of threats, and you see sometimes, like today, you want anything, you must have a CRB clearance certificate. It becomes hectic. I'd say it's hectic, especially if you default. But also it depends on the period you've defaulted, because if you default shortly, then they can maybe close an eye for that. These loans are very useful, I must say, very useful. They sometimes save you from trouble even your friends couldn't have saved you, all right? So most of the time I borrow, it's mostly for food, or you're short on rent, or maybe you're short on, okay, you need to top up school fees, it's end of semester. And these are the times you need that cash, okay? The problem now is when people begin borrowing for luxury. Yeah? You're going out, you don't have cash, that's the problem. Personally, I've spent all the cash I've borrowed from digital lenders in good ways. And I also see people who borrow even to help at home. Yeah? There's trouble at home and you need to source cash. Everyone borrows from their mobile phones, yeah? So that we put all of it in one basket. I want to see these digital lenders reduce the interest rates in the future. I'd love to see them at least give you some privacy, some level of privacy. If you've borrowed, then it's me and them, not me, my contacts, my family, and everyone. I also love to see them give not just loans, but they can also kind of try to, like the way banks do, they can also try to mentor, if that's the appropriate word, mentor people who borrow this cash into maybe how they can invest them, rather than just give you cash. Okay, they can now begin telling you, we have this cash, we'll give you if you opt to do something, a project, open a business, something of that. So they should try to be like small banks, if I'd say small banks.
Amos Robbie there, very young, of course, borrower, narrating his experience to my colleague, Brian Mushiri. Let me just start with you, Rina. Let me get your reactions to what the young man has said in that brief interview.
First of all, I empathize with him for the experience that he had, but I love the last statements that he made around mentorship. And I think what he's talking about is being able to understand how to use money wisely.
Financial literacy?
Financial literacy, absolutely. It's like smoking. It's really as serious. How you have smoking adverts that say smoking can kill you. We need to have these digital lenders also stating that credit enslaves, and also how to borrow wisely, how not to borrow, how to save, how to plan for the future, how to manage your money wisely. Okay. I think that's a very huge component of what needs to be included in the services that they offer. The fact that warnings must be given, in addition to that, is education around borrowing wisely and ensuring that you're not over borrowing, and giving tips and ideas of how people can plan for their future, set goals and achieve them, so that we don't have people in a cycle of debt.
I'm listening to you, Rina, and I'm just wondering, what's wrong with me passing by Moy Avenue and seeing a very nice shoe of 4,000 shillings, I have 1,500, and I just borrow 2,500?
No, that is wrong. You know, the thing is that I'm not saying don't buy things that you enjoy or things that you love.
Yeah.
It is important to do that. However, we must plan our spending. The reality is that we don't have an overabundance of resources all the time. We have limited resources, and we need to ensure that these limited resources meet our needs, not just now or next year, but until the day that I go. And in fact, not just until the day that I go, but I need to leave an inheritance for my children. You know, it's not just spending money and then when I retire, I'm relying on my kids to finance my day-to-day living. It's not right. That's not how it's meant to be done.
Okay.
Now, I only work for a limited period of time. I get a job when I'm 20, I retire at the age of 65. That's a very short time to finance the rest of my life. If I live until I'm 100, what happens between the age of 65 and 100 years? Who is going to look after me? How am I going to be able to enjoy life and even just maintain my standard of living? Those are realities that are there. And so even as we are solving a problem of access to finance, we must ensure that people are educated and understand what that looks like and the implication of accessing credit to buy shoes and to go on holidays and finance weddings. I mean, what does that look like for my future and what am I risking? What is the cost of that money really? Is something that people need to understand. Yes.
I mean, Reginald, really, we can talk about the issue of perhaps not buying a shoe or borrowing to go on a holiday. But really, if my rent is due, you know, if my mother needs urgent cash, it might not fit the category of what I should borrow, but I have an emergency and that's the only thing I can turn to.
An emergency need to be also planned for. One of the tips we always tell people is have something for a rainy day, because you don't know when it's going to come. That's why it's called an emergency. Yeah. One way of sorting out emergency is insurance. Yeah. Medical is important because you don't know when you're going to get sick, how severe that sickness is going to be. So most people look at some of these insurance products. Not all insurance is good. Don't buy a phone for 200,000 and you have to insure it. That's anyway. But when it comes to health, if I have my small medical, I don't have to have a medical that I'm paying a huge premium, but something that I can go get consultation and work on from there. If you are able to, I always say most Kenyans are one salary away from poverty. If you lose your job today, Victor, tomorrow you are in dire straight poverty. That means you didn't plan for you losing your job because it's something that can actually happen. And COVID came and many people were caught unawares. But just to respond to what the young man has said about mentorship, digital lenders, mentoring and stuff like that. These guys are not mentors. Yeah? When you want when you want them to start doing many things, they lose the ability to specialize and to focus. Yeah? My advice to Kevin and some of the people that are in his industry who are not quote unquote profitable is maybe your skill set is on fintech, on AI, on automating the loan origination process, credit scoring. Those are your skills, and your skills are not on lending and following up money. Partner with someone who's getting cheaper money, getting money at 1%, 2%, like our commercial banks. Offer your platform and your technology to them to reduce their costs of lending. Get paid for your platform, either an annual license fee, a leasing fee, and everything, and you stick to your area of competence. But you're a computer engineer, you're good in developing AI, now you also want to be a banker and lend people out money. The next thing these guys are going to come to us is to ask CBK that if they can be deposit taking. Then all of a sudden they've just become another SACCO or another bank. So it is important to not make digital lenders to start saying, go train people. That's a cost. Who is funding that cost? What is the job of central bank, CMA, and RBA, if not to actually go and train people? That guys, you know, they are digital lenders, but these other whatever, they have a budget to do that. I might not have but for me that becomes a social good, which becomes very expensive.
And Kevin, part of that financial literacy that Rina is talking about is because sometimes we spoke about the issue of transparency earlier on, but there are those people and lenders who actually, you know, indicate very well that, you know what, me, I'm going to use your data by the way. Me, I'm actually going to call your mother to tell them to pay back your money. But personal responsibility also comes when we talk about clicking accept. There's a running joke of we accept like terms and conditions because people don't really have time or don't even bother to read what's there and what's going to happen to me.
And that's what I was saying earlier. Financial literacy is critical. And I agree with Reginald in the sense that there is a cost, but I disagree with everyone when they say we don't care. We do care. Remember, we're entrepreneurs, we're businessmen and women. We think far. We're thinking 20 years, 30 years. So what we want is a thing called predictability. I want to know that if I invest 100,000, I'm going to get 10,000 on top, right? And so what we need to do as an industry, together with the regulators, like they do in other markets, is come together, come up with a financial literacy master plan or something like that. And we all contribute our different resources depending on what they are. We have huge marketing budgets in digital lending. One of our big ideas was in March, we have a thing called Money March in DLAC. And the idea was all of us in the industry during the month of March shall use certain thematics to speak to the consumer, and those thematics were around education and around building back better, right? But if we don't get the support from the regulators, etc., then it won't be as impactful as it can be.
Okay, because you mentioned the regulator, I just want to play this soundbite of the central bank governor speaking about the amount of money that actually digital lenders lend versus, of course, the pain that sometimes comes with it.
We have more than 100 of these online credits. I mean, they are like mushrooms everywhere. But I think the point is that in terms of the volume of credit, how much they've actually put out, they are just a fraction of even they are a fraction of the smallest bank that we have. But in terms of noise and pain, whoa.
Given briefly.
That is a testament to our growth. I think what the governor is speaking to there is saying these guys were not even on the radar 5-6 years ago. Today they are, but they are still lending very little money in terms of volume. But then in terms of number of customers, so many because they're making noise, right? So I think that's the way you should look at it. That trajectory of where have we come from, where are we today? Yes, today we are only lending a small bank book, as he says. But tomorrow we could be bigger than the banks. Today in the US, the shadow banking ecosystem is as large as the banking ecosystem.
Speaking of which, there's actually a digital lender which acquired an existing MFI the other day.
Yes.
Yeah, but anyway, let's take this last set of feedback before we take a quick commercial break. Remember, we asked you, have you ever borrowed money on a mobile lending app? And of course, Josa says, these people made multiple annoying calls. To make the matter worse, they call all my relatives and the area chief. From that day, I don't take any loan. That is Josa. And then Empress Spice says they are the main source of unemployment. That's why our CV references never pick calls, thinking it's those mobile apps dead following. Thank you, Empress Spice. We'll try and get Kevin to respond to that. Yes, Super Betty says they don't have manners. That's why people default intentionally. Immediately after receiving the money, they start calling, start sending unnecessary messages in the name of reminding you on the payment date. Thank you, Super Betty. And Purity Muraga says they have been calling everyone in the family. My brother defaulted once, and I once asked them if they engaged me when they were lending him. They are just annoying. Saizo amepitisha na siku tatu pekee. Thank you, Purity. Figure Francis says it's be in good terms with them and you won't be disappointed. They have helped me numerous times during the emergencies, times when I had no one else to turn to. Thank you, Figure Francis. And of course, we have more. Diki Money says they are better than banks where money is limited to only successful unemployed. Digital, even though it's very little amount, but every Kenyan is recognized and can access so in a very easy way, I believe. Thank you, Diki Money. And Dogan Segun Mora says kuna mwenye he defaulted his loan. Kupigiwa akasema walipata accident wakakufa wote. Hata ni bahati yeye ameshika simu juu hiyo siku ilikuwa matanga yake. Mwingine alisema ako ICU in a critical condition. I think this is part, of course, of people not wanting to repay their loans. Viniko says walinidai nikasave namba yao. Nowadays wakinicall naongea kikale wanakata wenyewe. Okay, Laz Wainaina says they called out Granny because our cousin had borrowed and defaulted. She was like, kwani nyinyi amumjui, mkimwona mwambie alete ile pesa alikopa na simu yangu. Okay, that also perhaps will be an issue of identity theft. We'll try and address that after the break. George Bukoma wa Bungoma says they call almost 50 times a day using different people and different lines and almost 100 messages threatening to expose you to your contacts. Their interests are higher. Hata kama ndio tuko na shida hadi wanatuma message kwa WhatsApp. Surely. Thank you, George. Benjamin Richard says, Guy Fafa, I refuse to pay their 500 shillings. They called even my former principal hadi akajua sija make it in life. Nakopa pesa kwa apps. Thank you, Benjamin Richards. And yes, Benedict Nyawade says they give loans quietly. When the borrowers default, they bother people who are not party to their transactions with useless phone calls and text messages. Thank you, Benedict Nyawade. And finally, we have Naf Owit who says, I'm shocked by the comments here. Kwani, were we supposed to pay back? Again, really quite comprehensive feedback right there. And I think for me, if anything, all this feedback points to one issue, the issue of regulation. And when we come back from this quick commercial break, we discuss the CBK Amendment Bill, which is in Parliament currently, and what it means for digital lending in Kenya. Don't go too far.
StarTimes. Get connected today for only $9.99 aerial decoder and $2,699 satellite dish.
StarTimes. Enjoy digital life. Malaria ni ugonjwa hatari sana unaoua watu wengi hapa Kenya. Japo kuko na corona, hatari ya malaria bado iko. Mtoto huyu alikuwa na joto jingi, kutetemeka, kuumwa na viungo na uchovu. Alikimbizwa hospitali ya umma ambako sheria za COVID-19 huzingatiwa na ni salama kwa shughuli ya upimaji. Vipimo vilionyesha kuwa ana malaria na papo hapo daktari akampa dawa za malaria na kumshauri azimalize, na ili kujikinga wawe wakilala ndani ya neti iliyotibiwa. Malaria husambazwa na mbu. Walio hatarini ni watoto wa chini ya miaka 5 na akina mama wajawazito. Kupimwa na kutibiwa ni bure katika hospitali zote za umma. Usisahau adui malaria. Zero malaria huanza na mimi. Chukua jukumu leo. Komesha malaria. Ujumbe huu umeletwa kwenu na Wizara ya Afya.
Ukiwa na mtoto wa umri wa miezi 9 hadi miaka 5, usikose kumpeleka kwa ajili ya kupata chanjo. Ujumbe huu umeletwa kwako na Wizara ya Afya pamoja na UNICEF. Kumbuka, chanjo inakinga.
Fresh fried ginger has ginger oil, which is good for a healthy living lifestyle. It combines wonderfully on salads, stir fries, when basted on roasted meat, or simply sprinkled on your favorite dish. Now available in 250 ml, 500 ml, and 1 liter.
Invest in the prime plots from Finca Properties Limited, Equator Gardens Nanyuki, a gated community ready for immediate development. We also have Konza Suburbs, a gated community within Konza Metropolis. For details, call us today. Finca Properties Limited, prime and affordable.
Thank you for staying with your World on NTV this morning. We are talking about digital lending. Of course, Reginald Kadzutu is an economic analyst. Kevin Mutiso is the chairman of the Digital Lenders Association of Kenya, of course, as well as Rina Hicks, who is an investment banker. They are staying with me for the final lap of this conversation. And we'd like to pick up from just where we left the issue of regulation and the people who are actually working on something that will perhaps help regulate this industry, the Central Bank of Kenya. Let's get to listen to the Central Bank of Kenya Governor, Dr. Patrick Njoroge.
It's never too early to do the right thing, and we need to do the right thing. We know what the right thing is, so this is what we intend to do. Now, obviously people are more desperate, we know that, and that's why it is even more urgent to do the right thing, so that you don't add more pain to those people at this moment.
Rina, I think the governor is right on the spot there for the issue of adding more pain to people who are already in pain.
Yes, I mean, we've seen, the reality of where we are right now is that we have a health crisis, but more than that, we also have an economic crisis. A lot of companies have shut down, people have lost jobs, people's businesses have gone down or slowed down, and that has had a direct impact on our ability to generate income as Kenyans. And so that has resulted in people needing to borrow or even to rely on relatives to help them survive this season. A lot of people are depressed and facing high levels of anxiety.
Yeah.
And I think what the governor is speaking to is while they come to these opportunities that are available for borrowing, then there needs to be a way to ensure that they borrow responsibly, and that process of borrowing is not a painful process. Let me just also connect that with some of the comments that were made by some of the viewers a little earlier.
Yeah.
Clearly, we have a knowledge problem. It's a knowledge problem. Even when you see 90% of those comments are, Allah, when we were to pay back, And while I agree that literacy should not really be something that they consider, and I understand why, because of the cost, I find that when people understand what it means when they borrow and that they have to pay back and within what time and the risks that are involved, then they become more responsible borrowers and they stop defaulting the way that they are. And so I agree 100% with the governor. We need to help people, and the digital lending platforms are doing that in whatever small way that they are.
Okay.
But in addition to that, they need to help people understand how to do it well, how to do it responsibly, and to understand that we need to pay back and within this time, and what the repercussions are if you don't repay back within the time that you're required to.
Okay, but Rina, I mean, Kevin gave us a very brief history of how we came to be here. Some of these products were here, I think, should be 5, 6, 7 years ago. Why is it taken so long to have some bit of regulation in the sector?
I think the reason is because as the industry has grown, the way in which some of these lenders are requesting for money back has resulted in a lot of complaints. There was a season, I think it was 2019 or early 2020, when we saw all kinds of people complaining about the fact that they have been listed by the CRB. When they went into borrow a loan, they found that they had been listed and yet they had not borrowed. There were others complaining about their relatives being called. When these digital lending apps came up earlier, we didn't have these problems. And I think with growth of the apps has resulted in a lot more people adopting them and borrowing irresponsibly. And that's what has caused the reality that we see today where, a lot of people are getting phone calls from lending apps that they haven't borrowed from or being listed in the wrong way. And so these complaints are what has fueled the regulation that has now come in. I think it comes with growth, and it's with any industry.
Okay.
Initially, you find that there's no problem, but as an industry grows and problems are beginning to arise as a result of rogue players, then regulation has to step in to sort of limit the negative aspects of some of the things that are being done by people who are not doing business in an honest way.
Okay. Kevin, briefly?
No, I just want to add to that. When cars were invented in the early 1900s, they didn't have seat belts, right? At some point, people started dying, people started being thrown out of cars, and they decided, okay, as a standard, we need to have at least seat belts. That's where the regulation is coming. This is why it is coming now. We've identified the risks, we have seen the potential, and actually, I love the governor's quote, let us do the right thing. And the right thing is not just focusing on the customer, but also focusing on the business and ensuring the business can deploy the most amount of capital to that informal sector entrepreneur, who really needs the capital now in particular.
Okay.
Yeah.
But Reginald, part of this issue is also because really within the law we used to recognize deposit-taking institutions, and I think they were under the central bank, and others like SACCOs were under, SASRA and other regulatory bodies. But we didn't have this animal or these players who give out loans but do not take deposits from anyone.
I don't know whether Kevin will like you calling them animals, but this creature. But before I answer that, on the element of education, financial literacy, I think sometimes we leave these things too late. Why don't we have financial literacy in CBC? We have a new curriculum. Why not have financial literacy from there? So by the time that this person is becoming a 21-year-old, 20-year-old, he knows money, he knows budgeting, he knows planning, he knows borrowing. Yeah, there's a saying, you can't teach an old dog new tricks.
Yeah,
that's what we're trying to do now. Someone who's been surviving on debt, you're telling him now, no, you don't need debt. It's a bit too late. Every university course needs to have a financial literacy unit, whether you're doing medicine, engineering, or all those things, so that you can kill this thing of financial literacy from the beginning, so that by the time people are getting their first paycheck, it's not when you're calling them now saying, now you know you have money. By that time, the guy for the insurance is selling them insurance, the guy for the bank wants him to get a loan, Kevin is sending him marketing messages, borrow, and so he is trying to make decisions at that point in time. So we need to sort out that. Secondly, the governor said we need to do the right thing. It's not too early to do the right thing. I want to come and say, as a governor at that level of policy making, digital lending is not the right thing. The right thing that we need to, I like what he said, people are suffering. People are there's now an outcry. Why don't we have policies that increase employment and income so that there is no need for Kevin? Sorry, Kevin, but so that there's no need for Kevin for some of the things that we're actually borrowing for. So that people that are borrowing for, when you borrow to buy your mangoes, then you know that when I sell these mangoes, I'll be able to repay this loan. You're able to price your mangoes depending on the interest rate of your loan and all that stuff. Then we start using credit the right way. So I think as a governor, the right thing that we need to do is how do we sort the economy to create enough jobs and income for people so that they're not dependent, they're literally not dependent
Reginald,
on debt.
I would argue that should be in the long term, but in the short term, we have people who are literally hooked. We can't remove them from...
Victor, Kenya has been independent for how many years?
50-something.
Yes. So why are we saying now this is a short term? What have we been doing for the last 55 years where we are not been creating employment and income for our people?
Yeah.
So yes, back to your question. We have been doing deposit taking. And you realize why these guys are able to lend at lower rates, because their cost or source of funding is very, very low. A SACCO, you are paid between 10 and 11% per annum for your deposits. They lend out at slightly higher than that. A bank pays you nothing. And they can lend out at 14%. Digital lenders, one thing that I would love to see in the regulation is disclosure of source of the money. Because you are lending billions, like Kevin said. Where did you get these billions from?
And that will actually come out, I think, because this law will bring an aspect of scrutiny. Talk to us, Kevin.
The AML laws in Kenya are already very strong. We already disclose where our source of funds come from. We have now beneficial ownership requirements that are in the law.
Yeah.
And so that concern is a real concern, but we also feel that it's being addressed not just in this regulation, but in other various pre-existing regulations. I also would like to say, let's not always, think that the source of funds comes from a negative place,
Okay.
right? In the world today,
It can come from the church.
It can let me give you some statistics. You
Yeah.
have in the U.S. today, you have $1.5 trillion of capital not earning any return, right? It's called dry powder. In the Western world, you have $14 trillion of negative yielding assets. So there's a lot of capital in the world looking for return, right? So I think the focus should be, how do we get that capital, funnel it, and make sure that it comes to Kenya, so that we can enable the mama mboga selling those mangoes so that when she gets Kevin's first loan of 4,000 shillings, in 3-4 years, she's now buying trucks.
Okay.
So sending them to our new Lamu port to export them somewhere else. And that's the way we should be looking at capital.
So are the Digital Lenders Association of Kenya and its members ready to be now, first of all, in the law, to be supervised and licensed by the Central Bank of Kenya, which will now allow them to actually revoke your license, to direct and require any changes, of course, which might be necessary, to disclose the issues of how much interest rates and perhaps maybe justification for why you charge that. And the most important one, determine minimum liquidity and capital adequacy requirements for digital credit providers. Are you ready?
So the current bill as it reads, and this is why we've been trying to engage with the stakeholders, Parliament, the committee, CBK, and Treasury.
Yeah.
What we are telling them is that the law should be split into two parts. There's the consumer protection piece. We must protect the consumer. We must have a minimum rule book on how to engage with the customer. When we are collecting, when we are selling, when we are marketing, there must be that minimum set of standards that everyone in the market must follow.
Okay.
Right? So that we are very ready for and we are very excited about. The problem we have is when the regulation seeks to make business decisions that the business should be making. Telling us about how to price, approving our loans, approving our products, how long will those approvals take? We have, etc. That creates friction and will increase risk in the market.
Okay.
And then the final piece is the prudential guidelines, the minimum liquidity and the minimum capital. The challenge there is that those particular guidelines are usually for deposit-taking institutions. And the reason it is there is to de-risk those institutions in the event there is a run on their deposits.
Okay.
We are digital lenders. We do use our own private capital. We are not coming and taking deposits from different people. We're using our own private capital. Now, as a result, by making us have a minimum capital deposit, there's a cost of my own capital sitting as a deposit in the central bank, not earning return. There's also there's a cost to liquidity ratios, because I have to now price in to the end user the cost of holding all that capital, right? And that is not earning
so
a return.
You're saying we could in the end see even this loans, perhaps the cost going even...
If we're not careful. And that's why I'm arguing. I'm saying that the CBK Amendment Bill 2021 is a once-in-a-lifetime opportunity for Kenya, right, and for our industry.
Okay.
If you look at what happened in Nigeria, once the fintech law was passed, you had big money coming into that economy to build this industry of the future. Remember, fintech is a global issue. It was spoken of at G7. It was an agenda item in G7. It was an agenda item at the FDB AGM last week. Right? It's an agenda item in every global function today. It's an industry of the future. And the CBK Amendment Bill 2021 is a fintech bill. But we're losing sight of the potential of that bill by trying to clip wings and manage our capital and manage, how we talk to customers, instead of focusing, how do we ensure that the bill that comes in protects the consumer, but makes us grow at the exponential rate that we can grow.
Okay. Rina, Kevin certainly has his own concerns on part of the bill, but looking at, of course, the provisions of this bill, some of them I've read out, do you think then we would perhaps start to see the Kenyan consumer who consumes these digital products protected and even more safe?
Absolutely. I think one of the things I must say is that whenever you start a business, the idea is to solve a problem now, or a need that exists. And the idea here is to solve that problem. But then if there's an additional challenges and unintended consequences that come as a result of that, then something needs to be done. And that's what this bill is looking to respond to. In addition to all the other areas that it covers, as Kevin has said, it's really a fintech bill.
Yeah.
And so it's very important, and those highlights that you've made around issues around transparency, issues around knowledge and all of that are very, very important, and they will definitely help the consumer. But one of the things I also must mention, while regulation is critical to ensure that there's consumer protection, that the regulators in the implementation and execution of those regulations must also ensure that they don't stifle business and don't stifle innovation and creativity, because it's through these businesses that the economy grows, and that we're able to ensure that people have jobs and the economy functions effectively. And so there has to be a dual role, one as a protection of consumers, but also as an enabler of business. And the regulation in the execution, when the CBK is executing this bill, then needs to, once it's enacted, needs to ensure that it also is an enabler to ensure that companies in this space of fintech are enabled to succeed and to grow. And it's very, very important that regulators see that dual role between consumer protection and also then enabling of business.
Okay. Kevin, before we take a quick last set of feedback from our viewers and, of course, your closing remarks, briefly, for anyone who is watching right now and they're considering taking a digital loan, what should they know before they go ahead and download that app?
What they need to ask themselves is, what are they using that money for, right? If you're taking 5,000 shillings and you're not going to get 6,000 shillings for whatever you'll use that 5,000 shillings for, take a step back and ask yourself, why are you taking that loan? You do not need it, right? The loans we give are for economic activity. Think about loans like fuel. We want to fuel businesses. We don't want to poison. You know, fuel, you can drink it and it fuels the car, and then you can also put it somewhere else and it kills you.
Yeah.
So our objective is not to kill people. It's not to enslave people. Those are the unintended consequences.
Yeah.
Our objective is to put fuel into these small, medium enterprises, informal sector, boda, mama mboga, so that they grow.
Okay. Reginald, until, of course, the interest rates are much more lower and affordable, because he's talking about they don't want to target borrowing for daily needs. They want to help businesses. But until the rates are much more affordable to a way that, I can still get return on investment when I take this loan, we're not doing anything. We're not growing the economy. I'm just borrowing at a loss.
Truth be said, because if your interest is 7% or 10% for a week or for a month, and I'm a mama mboga, all of a sudden, you've eaten into my profits by 10%. One thing I don't agree with the proposed law is on the minimum liquidity element of it. These guys are lenders, so there's no need for minimum liquidity. They are lending out their money, so to speak, because they've gotten it from somewhere.
So they're technically liquid.
Yeah, they're technically liquid. If people default, it is their own money that they're
not depositors' money.
Yeah, not depositors' money. So, and as lenders, there's one risk a lender always takes, that the person is going to default. Just like the people that lend to Kenya. They lend to Kenya knowing that this government might pay us or might not pay us. Thank God IMF comes to bail you out.
Okay.
So as these guys take that risk of lending, as much as they're going to be regulated, make sure the business grows, they need to know that there is that huge risk that people are going to default.
Okay.
If then their pricing is not going to come down, he said cost of funding is 28%.
Yeah.
That if his cost of funding is 28% and he's lending out at 30%, tell me which business venture in Kenya is going to give you a return of 30% per month.
Okay. All right. Let's get to some last set of feedback. Remember, we asked you, have you ever taken a loan from a mobile or a digital lending app? Yes, Henry Kivuva says, oh yes, those people are very expensive rates, and they start harassing you even before the due date, sending 100 messages and calling 50 times a day. Not to mention the threats if you don't pay back by 10 o'clock. why do you pay? When you pay, they start enticing with higher limits. Thank you, Henry Kivuva. We have more. Yes, Simon Adriel says, I have had both bad and good experiences. The bad experience is something you cannot want to happen again. Thank you, Simon. Anita Ann says, nilishindwa niaje walipigia ex wangu kumwambia nilimweka kama garanta. Jamaa kadhani bado sijawahi pata mtu. Iliniuma sana. Waliponicall tena niliongea Kikamba akakata simu na hivyo ndio walichoka na mimi. Thank you, Anita Ans. And then Imbusi George says, they do not handle clients professionally. Thank you, Imbusi George. And of course, the rest of you have been sending your feedback on social media. They've been in hundreds. We've tried to sample some of them. But we have to close this conversation. And Kevin, I want to start with you, especially on the issue of, because there's someone who said they spoke Kikale and there's someone who said they spoke Kikamba on the issue of not paying back, as well as your parting shot.
Well, paying back is important because these days there's digital records everywhere. So behavior is being tracked, and what you want to ensure is that when it comes to matters financial, you're in good standing, because you don't know what will happen when you 10 years from now, when you want to start a business, when you want to enter a new job, when you want to move into a new house, get married, etc. And I like Rina's approach that let's also not just think about 10 years, let's also think about what happens when you retire, right? So financial literacy, understand money. Yes, we need to do a better job at teaching. I love Reginald's idea. Perhaps it should be in CBC. But yes, and then my parting shot is this. The CBK Amendment Bill is a once-in-a-lifetime opportunity for Kenya. This bill is what's going to bring in all the capital that's required to invest into the small and medium enterprise, the informal sector, if done correctly.
All right. Reginald, I'm giving you 30 seconds if you can do that.
Okay. For me, two parting shots. I think the regulation needs to be a different regulation. It should not sit under CBK Act. They should actually just do a completely different regulation for, as Kevin said, for fintech and such related digital deposit-taking institutions that are not SACCOs and MFIs. Secondly, I think that the fintech digital lenders need to stick to their core competencies, which is being able to do fintech. I look at companies like Flutterwave. Flutterwave did not come and say, now we produce for you electricity. They just say, we make you, the way you pay your electricity, more convenient. Amazon says, we don't write books, but we make the way you buy your books convenient. These guys want to make access to credit very easy. They don't have to be the ones supplying the credit. Let them be the fintech that gives an institution like a SACCO and MFI the ability to do it the way they're doing it without being the ones who are supplying the credit.
All right. Thank you, Reginald. And Rina, your final closing remarks in 30 seconds.
I have closing remarks for two parties, individuals and the lending companies. One is, as an individual, you have to take responsibility to understand how to manage your wealth, to grow your wealth, to save, to invest, so that you have a secure future. For those who are digital lenders, we start businesses to solve problems. As soon as we have unintended consequences, we have to deal with them. We cannot profit at the expense of people. And that, because if we do that, then we will not be able to build sustainable businesses. We have to build businesses that have sustainable business plans that help us to help people and to solve real problems and needs. And when you do that, you will be successful, not just today or in 10 years, but for generations to come.
All right. Thank you very much. Of course, we've been talking about digital lending in Kenya. It's a big thing. There have been concerns here and there, but we hope we have addressed all the concerns that you had. Of course, many thanks to my guest this morning. Reginald Kadzutu is an economic analyst, as well as Kevin Mutiso is the chairman of the Digital Lenders Association of Kenya in studio, and also joining us virtually this morning, Rina Hicks, an investment banker. We hope you enjoyed the conversation as we have, and of course, we will be back tomorrow again with yet another exciting conversation about health and health insurance, because the number of Kenyans who have medical cover in Kenya is very low. So we ask ourselves, what's going on? What's wrong? And the impact of that means that many people have to pay for hospital bills from the pocket. And what does that mean for the household income? Tomorrow, we have the Insurance Regulatory Authority, the National Hospital Insurance Fund, one, of course, private medical insurer, and a member of the public to help us delve into this conversation. From me and the entire team, it's goodbye for now.